Our next guest says it is not too late to get into the winning reopening stocks. Dan Suzuki is a Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, great to have you with us. Your message to investors is also similar to what Brian has just been saying in terms of do yourself a favor and get out of technology. So you do that, and you still think that there's a pretty long runway into the cyclical trade.
Yeah, that's right. It's good to see you again, Melissa. I think that, it's kind of a little bit boring maybe for your viewers, but I basically have the same message that I had last time I came on the show, which I think was back in December, is that we're sitting on the precipice of, probably the biggest profits recovery in a decade. And, the way to maximize your gains is to sort of increase your exposure and your leverage to those parts of the market, which are, again, the deep cyclical, small caps, value, emerging markets, all the stuff that's generally been working, although it's sold off a bit over the last few days. And I think you want to also minimize risk. And I think the way to minimize risk is to avoid, the frothiest, most expensive parts of the market, which are also the most crowded. And also, if you're worried about interest rates, it's the same areas of the market that are at risk. So I think, you can both maximize your gains and minimize your risk at the same time. And it's not often that you can do that in the markets.
Hey, Dan, it's Jeff Mills. Thanks for being on. I just had a quick question, on this cyclical theme. One of the areas that I think has been forgotten is real estate and REITs. This is an area that got thrown out last year because of exposure to office buildings and strip malls and things of that nature. How do you feel about that particular area of the market when you're thinking about the cyclical trade? Because it has been kind of a stealth underperformer this year.
Yeah, it's a great point, Jeff. I think that, if you think about it, a lot of things, normal cyclicality got flipped on its head last year. Tech, which is actually usually quite cyclical, was actually very defensive last year. And then REITs and real estate, which was actually usually very defensive, was actually very cyclical last year. And I think that just speaks to the nature of the pandemic. So I do think in general, investors are going to be best served looking to the areas of the market that have the most runway for recovery, which means they have to have gotten hit last year. Real estate's included in that. I just think that, if there are areas that may take a little bit longer for that profits recovery to come through, real estate is probably one of those areas. But, if you have a long time horizon, I think it does make sense.
Hey, Dan, BK, so I'm kind of curious. The one conundrum in the market here is we're starting to see some weakness over the last couple months, and maybe it's weather related, maybe it's not. PMIs are decent. But I guess in your mind, does the cyclical recovery in this reopening trade, does it depend on a strong economy? Or if we simply get infrastructure spending, a $3 trillion bill, is that enough to keep this cyclical trade growing? Or do we actually have to have real economic growth underneath?
Brian, I think we absolutely have to see real economic growth. And I think that we are going to see big economic growth. And I think, to be fair, there's a lot more visibility than typically at this point in the cycle than you normally have. So, some of that recovery is absolutely priced in here. But I think that if you look at the history of markets, there's clearly, we're still early in this. I think there's plenty of room for recovery. The fact that I'm sitting in my bedroom talking to you guys through a camera speaks to how just unnormal, how much room there is for a recovery and opening up of the economy. So I think this is a long-term story. And I think that economic growth will come through, and that'll benefit the cyclicals.
So that's a lot of information, Dan. Next thing you know, you're going to tell us you're wearing sweatpants, too, and not proper pants. But just to get to this runway, you said the runway is going to be 12 to 18 months. The market, of course, as you know, is a forward-looking instrument. And so at what point do you say it's time to pull the ripcord on even the cyclical trade? What are you looking for?
Yeah, well, historically, again, we probably priced in a bit more than normal for this point in the recovery. But historically, you still want to own cyclicals, while the acceleration is still happening. So I think that, if you look at the year-on-year numbers coming off of last year's crazy lows, you're going to see some ups and downs in the trend. But I think the underlying trend here is that you're still continuing to see further acceleration from here for a while. So it's not until late in the year where you get things like, growth potentially starting to peak out and then looking at stimulus starting to peak out, people starting to talk about taxes. So at some point, there may be a difficult discussion to how much of that the market can absorb without some more volatility. But I think that, we're ways off from there. So I think, we have a good amount of recovery, good amount of acceleration. So I don't think you want to jump off the cyclical trade here. And by the way, it's cheaper, than the rest of the market.
Dan, great to speak with you. Thank you.
Thanks, guys.
Dan Suzuki from the bedroom.
Shepard Smith here. Thanks for watching CNBC on YouTube.